I am joined today by a stellar panel, and I have to admit I'm somewhat wondering how I managed to get up here with the likes that I've got. Many of you would be familiar, John Welborn, Bronwyn Barnes and Jeff Quartermaine. I'll start with Bronwyn. Bronwyn's has a career of more than 25 years leading exploration and mining projects internationally, particularly in Africa. She has a particular skill set in working collaboratively with governments, and her achievements in the resources sector have seen her honoured in 2015 with Chamber of Minerals and Energy Outstanding Women in Resources Award, and she also got the National Exceptional Women in Resources Award. She was inducted into West Australian Women's Hall of Fame in 2019 for her services to the sector, and she's currently CEO, President, and I think Director as well of High Performance Exploration with High Power Exploration (HPX) with a project, NIMBA project. Jeff Quartermaine, who we've seen many a time through Perseus, obviously, has more than 35 years experience in the board and senior management level. He's been CFO of Perseus, and he's currently Managing Director and CEO of Perseus. Perseus has been a very active mining company in many countries in Africa and has achieved great successes under Jeff's management and leadership. Lastly, John Welborn, he's the Executive Chair right now of Phoenix, Non-Exec Director of Equatorial Resources. You've had a role as MD and CEO of Resolute, Chair of Apollo, and you're also President of Rugby WA. One of my colleagues pointed out that we both played in the same position in rugby, except my career stopped at the under-16s rugby team, while yours obviously continued much further. So I'm absolutely honoured to be here with you. Thank you all. To start the discussion off, I guess in terms of my experience, I see a lot of work in the concession space when it tends to be a problem. People tend to always call the lawyers when there's a problem, and not so much when everything's going fine. What I was hoping, Bron, perhaps if I can start with you, what's your perspective of mining concessions and mining in Africa? The things perhaps that I don't necessarily see.
Just making sure this works, and yes, it does. Look, thanks very much, Nick, and it's a pleasure to be here today and to be speaking on this topic with you all. I guess a long history of working in multiple jurisdictions across both, East and West Africa, and mainly in the area of transitioning projects from exploration into the development space, where you are in this space of negotiating mining concessions or mining conventions to support the project into development. I think, as we all know, to speak about Africa as one grab bag of Africa is incorrect, and that every country has its own perspective and its own challenges that it wants to see addressed as part of its efforts to progress its own mining sector. So I think this, understanding the environment in which you're operating, understanding the needs of the host country and the host government, of what they would like to achieve out of their development of their mining sector, and then having a very clear idea, of course, as the mining entity, about what your base economic case is for taking your asset into development. And it's being able to articulate that base case of economic sort of development to your host government, so that everybody's clear up front as to, basically who's getting what out of the development, I think, is probably the first starting point.
Yeah. Jeff, in terms of, I guess, one of the things that we've talked about previously was the misalignment of interests and perhaps the misalignment of expectations. Have you seen, what are the sort of, how often do you understand or get a sense from host nations when you're speaking with them that there is this disconnect in terms of what Perseus is bringing and what the country is after?
Well, look, there's certainly potential for misalignment, let's be clear about that. But I guess that is the role of the company when you're going in, is to make sure that that misalignment, if it does exist, is eradicated, and to sit down and to share your thoughts and to understand precisely what it is that the government's expectations are, and then to see if you can actually massage the situation to get an alignment. I mean, it is terribly important that that all parties understand what the rules of the game are before you get going. And I mean, you know, you mentioned, you know, my background in Africa. Well, I've certainly had that, but I've also worked in quite a lot of other developing countries around the world as well. And certainly my experience in Africa has been, actually it's been quite a lot better than it's been elsewhere. So it really depends where you are, what the time is, what's happening, what people's expectations are, and then you've got to work to make sure that you are as aligned as you can possibly be. And even then, you still get surprises from time to time.
And John, for the many different companies and the projects and so on that you've been involved with along the way, how often have you had that sort of regular check-in or adjustment to make sure that those interests are aligned and continue to be aligned?
I think all the time. I concur with both Bronwyn and Jeff in relation to the importance of setting the rules at the start. And then I think the secret is in the title of this panel, which is, I don't know if it was meant ironically or as an instruction, but you know, the unbreakable bonds and the value of enduring mining concessions. You know, we've all, I think, you know, Jeff's point is there is alignment and there are lots of success stories, and Perseus' operations are some of the best success stories of a company that's paying tax, employing people, and can demonstrate huge fiscal benefits for their shareholders and all of the stakeholders of their project. So that's a great example. But it's because largely the expectations, as Jeff has described, not only were identified going in, but have been maintained to some degree, or, as you're asking, you know, they're capable of variation by mutual agreement. So the answer to the question is all the time, but, you know, I've, like everyone on the panel, have worked in a number of different jurisdictions, and, you know, again, ironically, you mentioned I'm executive chairman of Phoenix, so I went to Africa 15 years ago because I assumed that everything in my backyard had been picked up by people more experienced than me, and that I should go to emerging economies where there was an appetite for capital allocation and an opportunity. And I still agree with Jeff that those opportunities are really exciting and in many cases obvious in the African continent. But I'm back mining here in Western Australia, and you know, the themes are very consistent. I remember Colin Barnett speaking at this conference many years ago and talking about the value of the royalty regime in Western Australia and its consistency. So I've seen that you know, but even in the Western Australian case, as people will know, where there's an ongoing and endless conversation about regulation, royalty regimes and regulation. I think the important thing is, particularly in this context, is that capital allocation question and the overarching consistency that's required in order for a project to attract capital. Last night at the ministerial dinner, we heard the South African Minister of Mines saying that he will rate his mission here to attend the conference if he can attract 2 companies to invest in South Africa and build and develop projects. I mentioned to him that perhaps he should start with 1 as a target in order to get to 2. Not being pessimistic, but I actually think it's great to see. That's what this conference is great at, is recognising the value of relationship, but also the need for both parties to work on attracting capital. That's what makes these projects work. And so it's all the time.
We've also talked previously prior to this about fair and equitable distribution in terms of a partnership, and it's obvious to say that an enduring relationship requires a partnership which everybody is happy with, and you move on from there over the years. Bron, how have you seen that what is fair and equitable change over the years? how's perhaps looking at, say, just maybe as a tax regime previously, whereas now the tax regime is only one part of multiple metrics?
Look, I think it's, when we talk about the expectations of mining companies and the benefits that derive from projects, I don't think it's solely an African aspiration. I think it's a general aspiration that we've all felt probably over the past 15 to 20 years, is that there's a higher expectation of the benefits of mining that will be returned not only to the host governments but to also host communities. And I think that, we've certainly seen that reflected in the changing expectations of governments as we go to negotiate mining conventions or, operating sort of conditions for development assets. So, and I expect to see those expectations continue to change over time. I don't think that they're static at all. And I think that, generally what I've seen in the companies in the countries in which I've operated in the last, let's just say, 8 years, as an example, is that there's a growing expectation that financial benefits returning to the host country are increasing. And I think when you look at the underlying desire of governments, particularly in African jurisdictions, we've got this growing population of youth that are extremely well connected to, social media, and they have access to other platforms or other international jurisdictions. They see what's happening in other parts of the world, and the expectation is, well, why not here? So I think that this expectation is rising very rapidly in Africa, and a large population that needs to be supported in health and education and housing, outcomes. Well, where is the revenue growth in the economy to support that growing aspiration? And I think, mining is very clearly a very important part of that growth of economic activity. So look, I think there is this aspiration and this requirement for further dividends from mining assets is going to continue to grow. I think we just have to accept it. I think where the balance comes into play is, what is then the return of capital that's invested by international companies in investing in these assets? There will come a balance point where investors can't see the return on their capital. And so, the capital pond will, start to diminish at some point. I don't think we're at that point yet, but I do think it's a fine juggling act that needs to be done.
Jeff, have you seen, a lot of the conversation here is about the mining company and the host nation and managing those expectations. How much do you have to manage the expectations of your investors and financiers and so on? Because that, in my mind, your convention will need to support the repayment of capital.
Yeah, look, that's a very important point, and it's one that's quite often overlooked. The equation's pretty simple. It's called risk-return. Now, if you're generating returns, then people will be more tolerant on the risk side of things. And the unfortunate thing, of course, is that risk, it's in the eye of the beholder, and perceptions of risk vary dramatically. I made brief mention of this during my presentation yesterday about the African discount that applies to us, say, relative to our Australian peers or North Americans, and I can assure you it's extremely strong. So, and also the tolerance level of investors is very low. They read the media, they see an event occurring in one part of the continent and then immediately draw a straight line to us and then say, oh, you've got the same problem, and capital flows away. So it's a very, very finely balanced situation right across on both sides of the fence. And, you do tend to attract a certain sort of investor actually after a period of time. And, and I think it's one of the things that has evolved is, we'll try and broaden our base by paying dividends and things of that nature. But at the end of the day, it's all about returns. And, if you can keep returning to the shareholders, they're going to stay happy.
And again, well, returning to the stakeholders, I guess.
Well, the stakeholders, I mean, you know, it is a very interesting point. It comes to one of your earlier questions about fair and equitable distribution and what does that actually mean. I've had some interesting conversations with some of my host governments where I've said to them, well, look, just think of it as like a cake, right? We're cutting the cake up and everyone's going to have a piece. You get to like the cake and you want a bigger piece. That's fine, but who are you going to take it from? You know, are you going to take it from the community, or are you going to perhaps ask me to pay my workers less money? Is that what you're asking? Or are you asking us to pay a discount to our suppliers? Or do you intend to take it from our shareholders? Well, if it's the latter, then we won't be building. And that's, you know, that is the hardcore fact. There is a point that you will cross the line when you can't generate or can't demonstrate a decent return, your shareholders will disappear. And it's trying to find that split between who gets what, which is the most complex and pressing issue for you from the day that you conceive the idea to the day you finish.
And John, how often, one of the things that, at least in the legal space, you talk a lot about is stabilisation clauses, and they get used in certain things. Is that something that you've seen as being valuable from your day-to-day operation perspective?
Well, you'd love the answer to be yes, and you know, I worked with your colleagues on a convention 10 years ago or so that I'm now stuck in arbitration on in relation to the actual consistency of it. So obviously they're fundamentally important for the reasons that we're all talking about, that you know, how the convention effectively, to pick up on Jeff's comment, regulates how the pie is going to be split up, and the stability clause gives confidence to the capital provider and the operator that is, you know, when you're doing a discounted cash flow on a 10-year project life, that you can rely on that economic driver over the course of the mine life, which justifies the capital. So yes, they're fundamentally important. And you know, the longer I look at you know, earlier it was said that you can't look at Africa as one puzzle, and it's a little bit like the Africa Down Under logo behind us, you know, the map of Australia crowded with all those different African jurisdictional flags. But there is this balance. One of the things that Jeff and I spoke about last night is the importance of timing. And to pick up on Jeff's point, Perseus is a really obvious example. There are jurisdictions which they are currently building in, which have demonstrated the faith of Jeff and his investors and debt providers, or in their case capital providers and allocation, that they're going to build, to use your word, Jeff. There are others where, you know, where currently it's not capable of development, and doesn't mean that they're not there, they're not holding their investments, but certainly, you know, it's a bit like surfing. You know, the mining is we're often focused on the commodity price, which drives the ability to start paddling and get the project up and stand up and surf the wave. But mining concessions, the subject of this conversation, and/or the stability of the jurisdiction, or more importantly, its economic drivers set by either the mining code or regulated by a convention, has a similar importance in terms of timing, getting involved in and that's because of the balance I think Bronwyn was talking about, or even Jeff referred to, about what happens at the start of a project and about what was perceived to be an equitable split after the project's up and the capital's been deployed and people have forgotten about the risk and the required returns on that risk. You know, there can be a view that we need to reallocate the rewards of this project now that we see them, and that's a bit late. And that, you know, drives this sort of seesaw that we see. So, you know, again, coming back to the title of the panel, you know, we see all over Africa that in fact the mining codes and the conventions are not enduring. They're subject to change, and that makes mining development, where it's risk capital over years and years, and in many cases decades, to build projects. I mean, the globally significant Simandou development in Guinea and the infrastructure that relates to it is an investment that is really a 100-year investment in infrastructure and unlocking the value in resources. And it's a great example of how there needs to be stability in order for that to actually work, and in order to justify not just the initial investment, but the investments that come after that capitalise on it.
Bron, one of the things, and picking up, John, on your point about the infrastructure and the duration of the investment, bulks business versus a smaller high-value unit business. How different are the expectations that you have to manage on a box business versus a high-value unit?
Yeah, look, I think, this is the interesting question that, relates to the different commodity sectors that you're in, obviously in different, jurisdictions. And once again, it's not a one-size-fits-all. So obviously with HBX, we're developing the Nimba iron ore asset in Guinea, and we're proposing to export through Liberia under framework agreement with the Liberian government for an existing rail that sits there. And that rail at the moment can take our phase 1 planned production capacity, but it certainly won't take full production capacity of 30 million tonnes when we get there in about 5 years' time. So the longer term investment that we'll need to secure for the upgrading of rail and port infrastructure is a significant burden. Now, whether that gets funded through the HBX balance sheet or whether we move that off our balance sheet and that moves into some kind of a public-private partnership is a question that we're working through with the government of Liberia now in the negotiations that we have with them there. But, that's just moving my CapEx into my OpEx, which is fine. This is how projects get built, is trying to work out the most cost-effective and the easiest path for us really to get into construction and production. But, once again, we've got a mine life that's looking at this stage, based on our current resources, a 34-year mine life. Now, I need stability both on the Ghanaian side in terms of production and what my royalty regimes are in Guinea, and that's fine. That's embedded into the current mining convention that we have. The unknown factor for me now will be my OpEx on the Liberian side of the border, and of course that's a complex negotiation that really involves both governments. So it's obviously a different set of scenarios that I'm facing in developing this asset than Jeff would be facing in developing his other, proposed gold projects in different jurisdictions. And I think this is, the fundamental barrier that we all have as bulks or large project developments in Africa is the infrastructure is not there. It needs to be invested in. I think, overall CapEx for our planned infrastructure long term will be somewhere between $3.5 and $5 billion US. And so that's a significant investment to go into a jurisdiction that will require significant comfort from incoming investors as to how that investment will be managed, what will be the returns that will be split between governments and then, the operator and then also the investors into the CapEx. So not easy questions to answer and, and then you're all trying to crystal ball this as well to say, well, who else could be, operators in there, in terms of using capacity on expanded infrastructure, and very similar to what we saw in the Pilbara 15 years ago. Questions about what is the benefits of multi-user infrastructure versus what are the benefits of infrastructure that's owned and operated solely for the mining company, which we've all seen does not create long-term benefits for the broader community and for bringing other regional operations into development.
Yeah, I think I can summarise that as saying that it's a lot more complex with the bulks. To pick up on your question, as someone who's built and operated gold mines in Africa and then tried to build iron ore capacity and still trying to, the advantage that the gold miners have, and again, Jeff in his operations are great examples, is that your possession is a lot more obvious when you build a plant or invest capital in a location on top of the resource that you're mining, and your stakeholders are in and around the mine site and or the processing hub, and effectively you're flying your product out in a helicopter or a fixed-wing aircraft. And whereas a bulk miner, which might be hundreds or in some cases thousands of kilometres away from the port, you're really responsible for not only the definition, extraction, processing of the material, but then its transport from the mine site to a port, into a boat, all the way to your customer, which, assuming is China or in some cases European markets, but a long way away. And so the importance of the convention isn't just the mining or the processing, it's the operation of roads, rail and port infrastructure. So it's hugely complex, and you see that in the decade-long challenge of developing globally significant projects like Simandou.
Yeah, that's exactly right. And to your point, Bron, as well, and one of the things we're starting to see now up in the Pilbara is that as it becomes busier, people are having to cross linear infrastructure, which is becoming a big problem. And if you have a Simandou type scenario with the multi-user rail, at least it reduces the extent of the interactions. So it's a different thinking that needs a bit of planning as well. One of the things, Jeff, that you mentioned a little bit earlier was around at least the return to investors, and it made me think of delay. And delay both in terms of being able to get on with your project, maybe there are interruptions and things like that, and how that is managed from a government perspective. And then also perhaps a bit of an expectations around when is the revenue stream, whether it be through income tax or dividend returns and things like that for the host nation. Obviously it relates to expectations, but at least on the project piece, what's your experience in how that's been sort of effectively managed, or times when perhaps you look in hindsight and go, well, maybe that example over there wasn't such a great one, I can learn from other people's mistakes?
Well, look, I mean, there's two parts to that question. I mean, managing the situation, delays, etc., with the host government, I think really the issue has to be there to manage expectations, to not overpromise when you can't deliver with certainty. Now, when things are starting off, people always want to think on the bright side, but if you've been through the hoops a few times, you know that it doesn't always work the way you want it to work. And so when you have the conversations with regulators, I think you've got to be very honest and say, look, if it goes like everything goes according to plan, this is where we end up, but this is where it's more likely to be. And then to continually have that dialogue to make sure people are fully informed along the way and understand what the issues are as and when they arise. So what needs to happen in a localised sense. From a company point of view, though, I mean, our strategy has really very deliberately been to be a multi-mine, multi-jurisdictional operator. And we have adopted that strategy fairly early in the piece, because when we started, we were a single mine, single country business. And I could see that, not terribly much had to go wrong for everything to come apart. So we set ourselves the task of going to other jurisdictions. We first of all went from Ghana to Cote d'Ivoire. We did a small operation there where we learned how to operate in a new jurisdiction without exposing the company by over-investing. And then as that moved on, we made a second investment, etc., etc. More recently, we have gone to the east side of Africa. We bought a significant property in the Sudan. And of course, everyone knows what's happened in the Sudan, and we're not building there right now. But it wasn't an issue because we had something else to deal with. We've got Nyanzaga in Tanzania, and so it's really about balancing the portfolio, giving yourself options. Don't put all the eggs in one basket. When I grew up as a kid, Mum never said that was a great idea, and it's still not a great idea. So, the idea of spreading risk across various jurisdictions, various operations, giving yourself optionality is terribly, terribly important if you aspire to be a consistent producer of returns to all of your stakeholders.
John, stakeholders, community, how much, obviously the community is important, there's no doubt about that. And that community, as you say, if it's a bulks business, that community can be a much longer, expansive footprint, which covers your infrastructure corridor. When is the best time to, I guess, start? How do you manage the community piece? Companies need to be able to contribute back to the community, but you might not necessarily be in a position where you can go and build, like a medical centre or something like that on day one. How far do you sort of have that conversation to say, okay, we're going to go and do these sorts of activities just to test the thesis, see whether or not there's a project there, and then afterwards we're going to make a much more concerted investment into the region and develop that community.
I think consistent with the other panellists' comments, it's about setting clear expectations. So, prior to the construction of the project, if there's an expectation that you're going to build a hospital and a school and or upgrade the infrastructure, then you either have to be willing to do that and allow that perception to exist, or you've got to explain that that's not our role. We're trying to get the project up, and at this stage we're in exploration, and this is what we're going to be able to do, and we're looking for these sorts of employees. However, if and when we build a project, whether it's part of the mining convention or in many cases completely separate to that, making clear what community benefits are part of the development of the project. And so I think that's fundamental, not just in African mining operations, whether you're operating in Australia or North America or South America or Africa. I think that's fundamentally important to obviously be consistent with your obligations under the mining code or under, whether you're an adherent to the World Gold Council's responsible gold mining practices or your internal values as a mining company, but then also understand what additional benefits, obligations and or requirements are in the local community. And it's a fundamental important part of mining developments. I mean, I remember one of the first African projects I ever worked on. I arrived at what was our exploration area and met the local official who was a sous-prefecture, and almost practicing my rugby players' French, I expanded on what we were here for, and we were an Australian company, and we were adventurers and searchers, and we were trying to find mineralisation, and if we were successful we were going to trying to build a project. And I tried to explain that we weren't a taxi service, and we weren't a health service, and we weren't here to replicate the government's infrastructure or their obligations, but that we wanted to work with people and we wanted to provide employment, and we were hopeful that the reason why we were here and we were making investments that we could build a sustainable future operation, and that the only way we could do that was some level of cooperation. So I hope I managed to communicate that over about 10 or 15 minutes, and he then responded very slowly in French, telling me there were 3 rules: no stealing, no public drunkenness, no stealing anyone's wife, or words to that effect. So I whispered to my exploration manager that sort of distilled the 10 commandments down into 3, and we tried not to break those, and that started our community relations. But hopefully in both senses, perhaps I was too descriptive in what we were trying to do, but certainly set expectations early, listen to the community, and whether you're in production and setting expectations or just starting, it's about not creating the expectation that you have obligations or a responsibility that isn't consistent.
Jeff, one of the other things I was thinking of, we've talked obviously a lot around community engagement and stakeholder management, and I guess the things that I see being more as the day-to-day piece. Obviously, a mining convention is written down and it's part of the law and the framework. How hard is it to maintain I guess, the strictness of the application of the code, whether it be the notices that are given, that when it gets down to the day-to-day implementation of the code, someone might say, yeah, you've got the approval to go and do whatever you want to do, the notice is in the mail, or you don't need a notice for this. How hard is it to maintain that, the hygiene around that, the diligence of it?
Well, it's not hard, that's a job. You don't sort of take chances around things, and you do have to keep a close eye on bits and pieces. That's just part and parcel of doing business. And I think certainly, where you do run into some challenges from time to time is time means different things to different people. In our world, perhaps we're absolute sticklers to time. We need to be for a whole raft of reasons, whereas perhaps some of the people that we're talking to see it in a different light. But no, that's very much part of the landscape. I was just actually thinking, reflecting on what John was saying there. I mean, that's absolutely the case about dealing with people and setting out the rules. I mean, one of the probably the more pleasurable experiences that I've had at Perseus was we were going to do some exploration in an area away from one of the mines, and I asked the guys to take me to the nearest village for a bit of a chat. So we went and sat out under the mango tree with the chief and all his officials and had this pretty interesting conversation, because we were speaking in very different languages and the interpreters were working overtime. But essentially he said to me, I want you to build this dam, and I want you to do this and all the rest of it. And I said to him, sir, I would dearly love to do that for you. However, we haven't done the exploration yet, and we'll, if we work together a little bit according to John's rules there, maybe that's something that we can do. Anyway, as it turned out, we did have success there. And about 5 years later, we were visiting that particular site, and I said to the guys, can you take me to the village? And I'd completely forgotten my conversation 5 years earlier, and we went into the place, and it was on. And it was fantastic for me to be able to say in that setting, I quickly recalled the previous conversation. Remember we sat here 5 years ago, we've actually just awarded the contract to build that dam.
Yeah.
And then I was able to go back about a year later, and we walked out to the dam and had a look at it. So, I think sitting and having those conversations, creating an understanding that, money doesn't grow on trees, you have to do certain things, but then you better deliver on it at the other end of things. You absolutely must live up to your promises, because if you don't, then that's when you run into real trouble.
Yeah. Yeah, no, that's, it's all about the delivery on what you've said that you're going to do. I see that we've got a few minutes left. I think that we can take some questions from the floor. Is there anybody who has any questions that they'd like to put to the panellists?
Hi, I'm Michael Cameron with Pato Media. I was just wondering, are there any common, perhaps sticking points, or when negotiating concessions in West Africa in particular, but also are there any common keys to success that you might have come across in your time?
I think that's a question for Jeff, since you're the successful one out of us, Jeff.
Well, I think we've already covered that, actually.
Avoid arbitration would be my tip, unless your Bronwyn is just one. So Jeff would be probably, at the other end of success.
No, well, I mean, I think we've already covered those sorts of things. I mean, you've got to sit and communicate, lay out the ground rules up front, and then you've got to deliver. Simple as that. I mean, I don't think there's any substitute for talking and making sure that everybody is as close as possibly aligned as you can possibly be.
Bron, have you had different experiences, or has it been the same as what Jeff has talked to?
Look, I think it comes back to probably my earlier comment around, every jurisdiction's different, every mining project is different, and there's always different sticking points in negotiating every mining convention. I think certainly echoing, your points, Jeff, around, these very strong open lines of communication. I mean, these negotiations never happen between 2 or 3 people. It's usually delegations that, are on both sides. It's usually supported by lawyers. They're incredibly lengthy. There's a huge amount of education on both sides, so we'll be educated around not only the expectations of host government, but also the detail of mining codes and what the expectation is inside country. And the education on the host government side is usually around, what is the particular commodity, what are the returns, what are the commodity cycles, and how that needs to be accommodated in any mining convention that happens. So look, I think, it's an education piece on both sides, and it's continual dialogue. And even when they're done and ratified, that's not the end of it. It's almost, that becomes when the real work begins, because, the project changes. There'll be a commodity cycle fluctuation. you know, there'll be Ebola, there'll be COVID, you know, that impact timelines that have been agreed. So it's actually the start of the relationship. It's like, you know, the engagement period is the negotiation, and then you're married. And to stay married, that takes a lot of effort. Otherwise, you're...
I think the point I'd add to that answer is transparency, and I mean it in a very specific way. I don't think the conversation that Jeff refers to under the mango tree is really fundamentally different to the conversation that occurs in the presidential palace or in the convention meeting rooms of the mining ministry in its concept about education. And explaining, for example, that the construction of a bulk commodity railway that's going to do 30 million tonnes a year of iron ore is not going to provide transport for chickens and goats and villages to villages market. And the understanding of the requirements of the capital markets or the debt providers to construct a project in relation to the timing on construction of a dam or a school, or in fact the way the benefits of the mining project are going to be distributed or could be distributed. You know, whether you're talking to an oil-based economy, you know, that we see in the Nubian Shield, who are familiar with the successful development of hydrocarbon extractive industries, where you can stand at the top of a hole in the ground and split the outcome 50-50, compared to the sustaining capital requirements of a gold mine and how it might be funded over its life. That's the sort of discussion. It's very different to talking about when the dam's going to be built under the mango tree, but it's about transparency. So the common theme, I think, is yes, you need to have those discussions. They need to be ongoing and they need to be clear. But the value of these conferences, hopefully, is to be transparent about the requirements and the operation of the asset, what it actually means to the local village if we're successful in terms of the scale of the operation. How will it impact the manioc farmers or the almond growers or the transport potential of the region? Similarly with the government, fiscal, tax, all these things. It's often difficult, and I'm talking about education going one way, it's also the opposite way. One thing we probably haven't spoken about is the importance of listening, because, everyone on the panel, we've all got a lot to say, and that transparency of what are our requirements, what are we going to do, what is it going to be like, is just so important to communicate. Just as it's important to stop and listen, what is the local community, the government, the mining ministry, the finance ministry, what are they really telling me? Because it's easy for me to say, well, that's not going to work, or this is what I need if I'm going to be successful here. But it's equally important to listen to the jurisdiction and say, well, is there a meeting point between what we're hearing? And that's about transparency.
I find that despite having done this many a time, listening to all of you talk, you never stop to learn and never stop learning, and part of that listening as well is to go through all these different experiences. I've certainly found this really useful, so thank you very much. Is there anybody else? I think timekeepers, no, I think we're short of time, we're run out of time. So let me close and thank everybody on the panel. Bron, Jeff, John, really appreciate the time that you've